It's time for our Hot Picks segment. Our next guest says fundamentals for higher for longer copper pricing remain, and he joins us to share 3 copper plays as well with exposure in first world jurisdictions. Joining me is Cole McGill, Director of Mining Equity Research for Stifel. Thanks for coming in. Good to see you.
Thank you, sir. Good to be back.
So we know that the past several years, copper discoveries are few and far between. Production is falling, grade is falling. So what does the supply side look like overall? We also know supposedly deficits are coming, right, later in the decade?
Yep, that's exactly it. So if you look at kind of the top 20 copper mines over the last cycle or so, you've seen grades drop, reserve grades that is. You've seen discoveries tail off as exploration expenditures are kind of disincentivized due to capital returns to shareholders. And you've also seen that percentage of production for the broader copper base decline. So that's kind of all juxtaposed against a backdrop that really, I think, excited investors about a year ago, back when in May of 2024, when copper ripped from $4 to start the year up to around $5.20. A lot of that was driven by a lot of new demand interest for the likes of energy intensity in the developed world. So you think about AI data center energy intensity, the electrification theme. But I think now that has kind of shifted with kind of the new world order with Trump coming in, a lot of the Western governments prioritizing bifurcation and domestication for national security and for job growth. So it's really interesting to see kind of where the copper space within the Western world is kind of going to trend to as development projects become harder to come by.
And then on the demand side, you mentioned the energy transition, electrification. How much of that is CEOs really hoping it's going to happen? How much of it is actually happening?
That's a good question. I think part of it comes down to the energy or the copper intensity per kind of gigawatt or megawatt of installed data mining capacity. Those numbers are traditionally more metal intensive than what you'd have from just general kind of GDP growth. So that's kind of another layer to our demand model that I don't think is fully priced into the copper price right now. Because if you think about it, an average copper mine is anywhere between 300,000 and 400,000 tons of copper production per year. It takes anywhere between 15 to 20 years to bring that online. You've got data centers that can be permitted and built within 2 or 3 years. So there's a bit of a supply-demand mismatch in terms of that timing that can kind of pull demand estimates that much higher.
Let's get to your top picks, or hot picks rather, as we call them. Top picks is Margaret call. So Hudbay, so you see deleveraging and growth here. What else can you tell us about Hudbay? Yep.
So Hudbay had a kind of gangbuster year in 2024, and a lot of that was due to kind of what I'm calling the triple threat with respect to their share price. And you've got execution across the asset base. So Pampacancha, which is a high-grade satellite pit to their Constancia operation in Peru, that's been firing on all cylinders. Their Manitoba operations have seen 3 years of kind of infrastructure optimization. So you're seeing more rock to cash conversion because the recoveries are that much higher. And then that's kind of the execution side. The deleveraging side is something I think is good for multiple durability. Their balance sheet has been completely reinvigorated over the past 3 quarters. They're trending towards being effectively net debt to EBITDA or leverage effectively 0. And then the third kind of leg to that stool is on the growth side. And that's kind of the theme, I think, of what I hope to see into 2025 is that kind of domestication, bifurcation aspect within the U.S. And their growth project is coming from Copper World, which has had a checkered past. It's been through different iterations under different ownerships and different bannerheads over the past 15 years. But it seems it's starting to seem like that project is now becoming that much more realistic within the company profile. They're fully permitted from a state level, so they recently got their air quality permit from the Arizona Department of Environmental Quality back at the beginning of the month. And that's now going to kick off a formal process whereby they're going to look for a JV partner. My read is I think it's likely to be a Japanese smelter. I think that's where you can kind of get the best cost of capital. And if you believe in the kind of smelter undercapacity thesis, TCRCs are at cycle lows. Those are the kind of vertical partners that are that much more hungry to pay up for a project interest.
Okay, let's roll through to your other ones here. Both of them in Arizona. Arizona Metals, you like the jurisdiction, it's high grade as well.
And again, the Arizona thesis is effectively, I think we see Trump come in. I think he kind of streamlines the federal permitting path for projects that see over $1 billion of capital expenditure, prioritizing domestication, prioritizing job growth, and national security concerns around supply chains. So Arizona Metals is 100% 100% owner of their K project, located about 90 minutes north of Phoenix. And they have what's called a volcanogenic massive sulfide deposit. Effectively, there's a 1-2 punch there of being high grade, so it lowers your capital intensity and it lowers your funding risk to get into production, so you can usually self-finance these projects a bit easier. But they also usually occur in clusters, similar to kind of what Hudbay operates in Manitoba. So there's that. Once you have an initial mill and an initial construction decision, that can kind of be used as a beachhead to leverage better return on investment for further discovery. And it looks like 2024 was kind of a show-me story where they showcase that the exploration thesis is working.
Right.
So they have a lot of catalysts coming up in 2025.
Okay, and then Arizona, Sorin, you call this a low-risk operation.
Yep, it's a low risk, it's scalable, it's got the right zip code, right jurisdiction, right geography, right geology, it's close to infrastructure, it's close to a well-known and well-educated labor force. Their catalyst through 2025, the market knows all that, but their catalyst through 2025, I think, is on the technical side, increasing geologic confidence with respect to their resource base to convert it to reserve so they can put out updated costing estimates. That's kind of low-hanging fruit. They have a traditional or near 100% conversion rate.
Right.
So I think that's a bit lower risk of a catalyst, and you also have the Hudbay investment that's kind of backstop that thesis.
And a